Hello and welcome to Rebank. I'm your host, Will Beeson. Sandy Kaul is Senior Vice President and Head of Innovation Research, Strategies, and Technologies at Franklin Templeton, the OG global asset manager when it comes to tokenization and digital assets. In this conversation, we dive into the newly passed Genius Act and what it means for stablecoins, banks, and the future of money. We explore Franklin Templeton's journey launching BENJI, their tokenized money market fund, way back in 2019, long before most firms were paying attention to digital assets. We also dig into Sandy's views on consumer financial accounts, payments, and investments in an on-chain world. Thank you very much for joining us today. Please welcome Sandy Kaul. Sandy Kaul, welcome to Rebank.
Thank you so much. It's a pleasure to be here with you.
It's great to connect with you. Great to see you as always. I'm glad we can do this on the record for once. Maybe the place to start is with Genius. So it was recently passed and signed into law. I think it does a huge amount in terms of formalizing a lot of the work that we have collectively been doing over the past many years at this point. And I think it provides a pretty strong framework within which not only stablecoin issuers, but regulated institutions, financial firms that might want to use stablecoins can also operate. I wonder if you wanted to share any views. What's your take on Genius? What impact do you think this has?
I'm with you. I'm super excited about the Genius Act, primarily because it is really, I think, putting a stamp of approval and really opening up the potential for a growing set of regulated players to get very comfortable with this idea that we are now building an alternative wallet-based ecosystem where we're going to be seeing stablecoins really performing the role of cash in that new ecosystem. This was not what was expected when people developed stablecoins. They thought stablecoins would really be an on and off ramp and that money would not stay in the wallet-based ecosystem. It would come out and go back into the traditional economy. But that is not the case. We're finding that the vast majority of stablecoin holders do not cash out of the stablecoins. They leave those stablecoins in their wallet ready to use them for whatever next transaction they want to do. And so this is really a way that we can now have confidence that this ecosystem is going to remain. It's going to grow. There's now some legality and regulatory frameworks to ensure that there are consumer protections, to ensure that there are transparency into what is backing the stablecoin. And all of that is going to be great, right? There's going to be oversight of the issuers. All of that is going to build confidence around the security of using these new financial instruments. The only piece that's kind of still outstanding as a little bit of a loophole and a little bit of an argument is whether or not we should be allowing stablecoins to provide yield from their collateral pool back to the stablecoin holders. There is a lot of pushback on this from the banking system because providing that yield really puts a stablecoin at an advantage over what a bank could do with the cash that the bank is able to bring into a stablecoin structure, because the bank needs that yield off that stablecoin structure to support lending. And that's really one of the key roles that banks provide, is providing that credit into the economy. And they'll be disadvantaged in this pursuit if they are forced to give away that yield. Then there's no cash in the system to spur liquidity around credit. And so they are pushing very hard to close that loophole. And we are actually very much in favor of that, because we think that if you need a cash instrument, it has to operate like cash. It can't be cash plus a return. There is an instrument that offers cash plus return, and it's called a money market fund, and it is a regulated security. So I think we have to maintain the clear lines between the two instruments so that both can fulfill their function in this new wallet-based economy.
Yep. I think a lot of that resonates with me. One of the perhaps most important parts, I think, about Genius is the fact that by enshrining stablecoins in the financial system, we're effectively providing a clear pathway, legitimizing this pathway of value onto upgraded instant settlement rails. I think that to date, crypto has been something distinct from the financial system, something that has sat outside the financial system. I think some people have kind of crossed over back and forth between the two, but they've been fundamentally distinct systems. I think a lot of the work that people like you, people like me, those in the space have been doing over the past number of years has been premised on the fact that blockchains are just better value transfer rails than traditional financial rails. There's no such thing as T+1 or T+2 settlement on blockchain. Everything is programmable, i.e. can be managed by software. Any asset or store of value that's instantiated as a token can be transferred instantly 24/7 to any other participant in the network, regardless of where they are in the world. And that has worked great from a crypto standpoint. I think many have seen the opportunity to apply that same infrastructure to financial markets. And in a sense, stablecoins are the first step in that direction because it basically allows people to port cash from traditional payment rails onto instant settlement payment rails. And what do people do with cash once they've moved it over? Well, they have a range of needs, and it ranges from investing it, earning yield, to doing a variety of other things. And I think that probably dovetails nicely with the work and I think the strategic direction that you and Franklin Templeton have been pursuing for some time now when it comes to digitizing in the form of tokens your investment products. I wonder if you want to make that connection for us.
100%. So first off, we believe that you're going to be able to invest and to use this wallet-based ecosystem in a much more efficient way with a lot more utility than you can do the same functions in today's traditional marketplace. And just a couple examples to make that real. We already are able to have our clients buy our tokenized money market fund using a stablecoin. When they want to cash out, we can return that money to them in a stablecoin so that those proceeds never leave their wallet. So when they buy our tokenized money market fund, the token sits in their wallet. When they sell it, the cash is returned into their wallet in the form of a stablecoin. Today, that would take several jumps between multiple intermediaries to happen in their bank account. And there would be having to some kind of delay of maybe as much as a day, or if you liquidate on a Friday, as much as 3 days before you would actually even be able to see that money. With the new rails, we can do that instantaneously. The other thing that we're looking at is new functionality by being able to keep the shareholder record second by second on the blockchain. Today, we have to wait till the end of the day to reconcile the shareholder record and understand who owns shares and who sold shares. And we have to wait until the next trading day to figure out the people who owns the shares and put a credit towards the yield into their account and accumulate that credit. And we only pay it out monthly, right? That's how it works today. But with our blockchain-based token system, we're able to calculate that yield second by second and pay it out every single calendar day in incremental new issuance of tokens. So that is happening 7 days a week, 365 days a year, including Saturdays, Sundays, and holidays, which is just not possible today. You don't get things credited to your bank account on a Saturday or on a holiday, right? So we're already seeing, just even in these small incremental changes, vast improvements in how our system works. And I think that you're just going to see all of those new benefits start to accrue increasingly as we see more products come onto the chains, as we see more counterparties come in, and as we see volumes and liquidity grow.
Mm-hmm. Mm-hmm. So I wonder how you think about stablecoins in their current form. And I think Genius does a lot to create a legal framework for stablecoin issuance and requirements on stablecoin issuers. Stablecoins, in my mind, have basically been, well, look, they're privately issued liabilities. These are tokens which are backed by pools of collateral, which are held by private companies. A private company basically takes money that a depositor gives it, holds that money invested in usually T-bills or some similar low-risk asset, and then mints a stablecoin back to the user. The stablecoin issuer stands behind a one-to-one redemption of that stablecoin back for the underlying dollars at any point in time. I think there is limited, if any, legal precedent for what happens in a sort of worst case scenario with respect to stablecoins. I think, if you think about what a bank deposit is, it's also a liability against a private institution. It happens to be a bank. There's very clear and extensive regulation around what it means to be a bank and what it means to have a banking license. Capital requirements of banks, which are meant to avoid worst case scenarios, but which, as we know, are not in any way foolproof. And then there's federal deposit guarantee scheme, which at least up to a certain amount means that the government's going to step in and backstop any effectively liabilities held with these banks, so deposits. Nothing like that exists with stablecoins. You could argue that it doesn't need to because of the fully collateralized nature. But I wonder how you personally and you as a firm think about where we are in the maturity curve of stablecoins. I mean, I don't think any of what I've highlighted are unsolvable problems, but I do think that it's difficult to look at stablecoins versus cash dollars versus bank deposits and say that they are like for like the exact same thing.
100%. I mean, the stablecoin issuers that are leading the volumes today are relatively new companies, and they have been building business models that have, in many instances, kind of created concerns for different people in the marketplace. And even though I think that they are really showing the potential of the new space, they're not the players that I think people are going to look at as equivalent in trust to the banks they have been dealing with their whole lives, or even the credit card companies, right? I mean, I think that there is likely to be, in the wake of this Genius Act, a whole new set of stablecoin issuers. And that next set of stablecoin issuers is likely to be where we see the volumes grow. Oftentimes, you do see very innovative startups take early leads and really begin to build market share. But once the more trusted players step into the space, particularly when it comes to cash, I just think that there is not going to be the same degree of trust. Now, banks may also use the stablecoin structure, right? There's also issues with tokenized deposits. There's issues with central bank digital currencies. It's not like these are potentially far superior instruments. A stablecoin is actually a pretty interesting structure. I almost look at it as it's like the equivalent of a digital check, right? Because you can cash it for the underlying asset if you want to, in terms of that on and off ramp. But I think that the more regulated players are going to come in with a different degree of transparency, a different degree of bundling this into a broader set of services. And I think that that is going to really start to displace some of these earlier players.
Interesting. There's a lot of chatter around, okay, post-Genius now, banks are going to start issuing stablecoins. I may be naive or not imaginative enough, but it seems to me like issuing a stablecoin is not a good business for a bank to be in. To your point, they're cannibalizing their deposit base, and they're doing so on a fully reserved basis, meaning the net interest margin is limited. And the flexibility of, I guess, what they can do with what would otherwise be bank deposits that they could lend. Tokenized deposits are something of a question mark in my mind. I mean, from a purely retail standpoint, does it really improve the customer experience? I don't really see how it does versus traditional bank deposits. I think you can make arguments about wholesale tokenized deposits being different. Seems like a lot of industry coordination would be required to realize that. And you get to the point of Bank A issuing a tokenized deposit, which their client transfers to Bank B. Bank B probably not wanting to hold a Bank A liability and therefore looking to settle it or convert it into their own tokenized deposit. Does that, firstly, it requires a lot of coordination, and secondly, how much efficiency gain does it actually deliver? Open question. Yet you seem to suspect that over time, new issuers might get into the stablecoin space or the tokenized cash equivalent space. How would you see that playing out?
I mean, I think it's going to be a defensive play. I don't think they can afford not to. I think on a certain level, they would prefer to not have to do it at all, or have people use tokenized deposits or tokenized liabilities. But I don't think they're going to get the option of foregoing, because they either see the cash moving out of their ecosystem into stablecoin issuers and not coming back into their ecosystem, or they're going to want to have their own stablecoins. So at least they're participating in the cash and they can at least recoup some of that lost net interest through the reserve pool and the yield that they're able to generate off the reserve pool. So I think it's going to be a defensive play. I don't know if each bank is going to want to issue its own stablecoin. We could see kind of cooperative stablecoins across multiple banks, a little bit like we saw with some of the payment networks that they put in place for instant payments. They shared that infrastructure rather than each creating their own. And we might see something similar in the stablecoin space, at least initially, until people get a better feel for the dynamics. I'm not as worried for the banks in terms of what it means for their lending base, as long as they are able to keep at least some of the yield coming off the stablecoin pool, because there are so many opportunities to use that stablecoin, even their own supply of their stablecoins, in these new kind of digital lending protocols, that I think they're going to see a shift in the lending model and it's going to become more decentralized. And I think banks will be able to adapt pretty quickly to those more decentralized lending models and find ways to use their stable coins that they issue or their tokenized deposits that they issue as part of those protocols. So it's going to be a shift potentially in the way that we see credit given in the system or lending done in the system, but I don't think banks are going to lose that role over the long run. I think they still have the trusted brand. And when it comes to people's money, they're going to want to go with that trusted brand and not with players that they've never really heard of and don't have much of a track record through many cycles of distress.
Mm-hmm. Mm-hmm. So digital asset custody for banks has been off the table for some number of years until recently. So I think the door is definitely open for that to happen now. That to me seems like the big unlock here. I mean, the obvious next step in my mind is banks offering accounts to their clients, which are digital asset wallets. And banks are holding stablecoins on behalf of customers in those wallets. Banks are allowing their customers to purchase other financial instruments, make payments on stablecoin rails. Probably then, too, I would imagine at least larger banks would be able to negotiate revenue share arrangements with, say a Circle or a Tether in the way that some of the larger crypto native firms do. That to me seems like a path that I would expect to materialize pretty soon.
And not just banks. I mean, I think every financial institution is going to need to offer its clients a wallet-based system. And there's sub-wallets, there's linked wallets, right? Where you end up wanting to hold your assets could look very different depending on what generation you're coming from. In our infrastructure that we've built and that we run our tokenized funds on, we already support some custody where we can manage the tokens we issue for clients on their behalf and manage the keys on their behalf. We allow them to do self-custody and take their own custody of the tokens that they've purchased. And then we also allow for third-party custody. And I think that interoperability across wallets is what you're going to see become the feature of the new system. And the benefit there is, instead of today's account-based system, where I then need to reconcile what is in one bank's view of my account versus another bank's view of my account, once I have a wallet address, I can show all the banks my wallet address. And if I provide the key, they will know exactly that that is my wallet and they will all see the exact same holdings. So it gets rid of this need to reconcile across multiple accounts. I can have my own wallet. I can link that wallet to whatever counterparties I need to be able to look through to that wallet. So it doesn't matter whether I'm holding it at the bank, whether I'm holding it myself, whether I'm holding it at a custodian. As long as I control the keys, it doesn't really matter where the wallet sits.
I imagine this is something you guys have thought a lot about, more than just hypothetically. You are one of the leading asset managers. I don't know the details of Franklin Templeton's money market fund offering, but other accounts that I've had in the past allow you to have a debit card attached to a money market fund balance so you can effectively spend out of it. So there are, I guess, examples in the past of different configurations of, in a sense, checking savings and payments. And especially as we look forward now into this, you could call it stablecoin rails or digital asset rails, and the way that you can build accounts and financial products on top of it. I wonder to what extent you guys have considered, okay, so you run BENJI, which is a tokenized money market fund, which we'll talk more about in the future. You service consumers directly who invest with you. Are there other products that you think you can offer going forward? BENJI's already deployed as a standalone app. Are there other types of financial products that can be wrapped into that?
100%, right? So if you think about what we've done with our BENJI tokenized money market fund, is we've kind of used it as the test case to build and prove out our ability to run any type of fund on these new rails, right? So we started with a US mutual fund, a 40 Act fund, and that was our original BENJI product. We have since that time created a secondary version of our transfer agent out of Luxembourg, and we've launched a UCITS version of our money market fund, and we've launched a private version of our money market fund and are working to finalize the launch. And it's already been announced that we have a Singaporean variable company version of our money market fund. So we've basically taken each major type of fund wrapper and we have rebuilt that wrapper to be issued as a token on the blockchain rails. We've deployed our system across 9 different public blockchains and 1 private blockchain. And we've opened wallets for every token holder on every one of those chains. So we've internalized cross-chain movements for all of our clients and really opened up this entire ecosystem for them using this tokenized money market fund product. And because we allow people to transfer it wallet to wallet or peer to peer with any other participant set up in our system, we're already seeing use cases where people are using it like they would use Venmo, right? Because a money market fund can be fractionable down to just cents and you can transfer that. So, we're seeing this idea that there is money and then there are money-like instruments, and those money-like instruments are increasingly being used like money. Another one that we're hearing a lot about is tokenized gold. I think you'll see many assets that have a clear-cut value that people view as a true store of value or as a true substitute for fiat currency. I think you'll see more and more forms of payment beginning to move into the ecosystem, not just fiat currencies or stablecoins, but more and more assets. It's almost like we're moving, I like to say, to a high-tech barter society where you can use goods to pay for things just like you can use cash to pay for things. And in a sense, that's a very old model, but it's, again, a very new model because it's on brand new rails.
Mm-hmm. Wow. 3 of the things that have really impressed me about Franklin Templeton's work in this space and things that I think make you unique are, 1, how early you started working on this. Others have launched private funds, tokenized private funds. You built a tokenized 40 Act fund, and I think you started... When did you start? When did you start working on BENJI?
We actually filed for that fund in 2019.
Wow. Secondly, if I'm not mistaken, you have a sizable team working on this as an engineering team. There are others in the space who have partnered with companies to help deliver the tech. You guys have built out, I think, a pretty substantial internal team.
Yeah, 100%. We really viewed this as a technology challenge that we could solve, and we wanted to solve because, if these rails prove to be as effective as we hoped they were when we set out on this journey, this would become our own infrastructure for our own firm going forward. So in a sense, we have been doing the proof of concept work to really build the platform on which our entire asset management business will probably be run over the coming decade. So I think that having that insight into how the technology works, having that talent in-house that really understands the digital native models, getting our operations, our network operations teams to be running verification nodes across 11 different networks. All of this is giving us the experience that we think we will need to operate as a modern asset manager. And that is a view I see more and more firms coming around to. I just think we're further along in our journey, and that's allowed us to really accumulate, I think, a lot of very important learnings that will hopefully give us an edge as we start to see this new ecosystem unfold. I think we will be absolutely one of the top firms, both offering products on these tokenized and wallet-based rails, but also, I think, really innovating and thinking about how do we make the entire financial experience better for investors.
Absolutely. And I think the third thing, which is related to that, together with BlackRock, and I don't think many other firms that I see, this vision at Franklin Templeton is straight from the top. I wonder if you could talk more about that and what impact does that have internally?
Yeah. So, first off, Franklin Templeton is a public company, but we're also in many ways like a family office because we were established originally by the Johnson family. Jenny Johnson, who's our current CEO, is the third generation of her family to be running the firm. And that creates a very different mindset, I think, when you really are in that position, right? Jenny thinks very clearly about not just what are our next quarter's earnings going to look like? Are we doing, the right moves to really build our broader asset management business? But she also puts a lot of thought into, are we really setting the firm up to be even more successful for the next generation? And in that way, we're much more like a family office or a sovereign wealth fund where we are really taking a very long-term time horizon and willing to make the investments that are hard for CEOs that are only thinking about the quarterly investment cycle to really stick with. As I said, we started this journey back in 2019. It's already been 6 years. Now we're finally starting to see the assets build in this space, but she had to sustain that enthusiasm, often in the face of people asking her, why are you making these investments? Why don't you wait for the market to develop more? But she's a visionary and she has a sense of responsibility. And she ran ops and tech in our organization at an earlier point in her career. And she really understands how transformational these technologies are going to be. So having that sponsorship is critical. But having that sponsorship with someone who is thinking long term is even more critical. And too often firms get caught up in the short termism of markets today, and they lose sight that some of the most important transformations, you have to sustain that momentum over many, many years until you see the payoff on that.
Circling back to the beginning of the conversation in stablecoins, I wonder if you want to talk at all about, in a sense, this spectrum of cash and cash equivalents. So on one side, you have stablecoins, and on the other side, you have T-bills, you have treasuries, and then you have products which invest in treasuries and have many, many decades of financial regulatory precedent and very high investment grade ratings, specifically money market funds, one of which you issue on-chain and manage. How do you think about money market funds, tokenized money market funds vis-a-vis stablecoins and the different roles and use cases for the two?
I think of them very simply. If you think of today, I have a checking account and that's the cash that I need to spend. And I have a savings account, which is also cash that I could spend, but I might choose to spend that less quickly because I'm earning yield on it. And therefore, it's cash that's earning something for me. And that's how I think of the difference between stablecoins and money market funds. And one of the things we believe very strongly at Franklin Templeton is that there is going to be this constant rotation of cash between those two types of instruments. Today, we already see major trading firms sweep all of their excess cash at the end of each day into a money market fund so that they can capture the overnight yield. You're not going to see that happen, but at the speed of blockchain within this new wallet-based ecosystem. So cash is constantly going to be cycling through stablecoins and tokenized money market funds. And this was one of the reasons, to go back to what we were talking about earlier with the Genius Act, it's so important to close that loophole around stablecoins paying rewards, because that really blurs the lines too much between the two products. And then what should you really be using to make payments? I mean, if they're going to make that argument, well, then I would argue that a tokenized money market fund is a superior form of payment because, as you said, it has this decades of history behind it. It is a regulated product. It is backed by the at the Securities Exchange Commission. It's something that, the issuers have had to really go through many more checks and balances to be able to sustain. So if a stablecoin pays yield and it's indistinguishable from a tokenized money market fund, I think it hurts the stablecoin case because the tokenized money market fund will probably end up being a superior form of payment if they want to act like that. So I want to keep the two products separate because I think there's separate use cases for them.
Yeah. Yeah. So maybe to start to wrap up, you started the BENJI journey, you said, in 2019. So we're 6 years on, but at the same time, you've explained to us that Franklin Templeton thinks in decades or generations. Where are we in your tokenization journey as a firm, and what's next?
So what's next is what I'm super excited about, right? We have, I think, really identified the collateral use cases, the liquidity use cases, the reserve pool use cases, the lending use cases that are going to all take these liquidity products, these tokenized money market funds, and really start to embed them as key tools in the new wallet-based ecosystem. So I think that entire stream of our business is about to blow up and become ever bigger. We are also have proven that we can issue a 40 Act fund, a UCITS fund, a private fund, and all of that is opening up now our opportunity to start our migration of our core investment expertise outside of money market funds into tokenized formats. And this is a great and fun opportunity because we're able to re-envision, if I could design from scratch what an investment building block looks like, how would I make that work? And, we're starting to see growing enthusiasm for tokenization of equities, tokenization of bonds, tokenization of ETFs. Those are all great options, but it's also a chance for us to say, well, how do I want to build portfolios in the future? How do I want to make sure that those portfolios can be aligned to individuals? We've seen a big move towards separately managed accounts and direct indexing in the traditional wealth world, right? Well, tokenization makes both those products much easier to deliver. I can have a token of tokens. So I could tokenize every equity in the S&P 500 and then also put all 500 equities into a S&P 500 token. And I could have the S&P 500 token, or if you asked, I could unwrap that token and you could have 500 individual tokenized pieces of equity. And you can see once you get that degree of transferability, you can start to do all new things with portfolio construction. So we're very excited about what we're going to be launching over the next year. I think it's going to really, open up people's ideas and open up people's thinking about with new rails comes new opportunities to enhance the way that we've done things traditionally.
Yeah. Well, it's so powerful. I think a lot of maybe the external focus is around getting assets as tokens. And, Robinhood announces tokenized equities and tokenized private shares. It gets a lot of mainstream attention. Very exciting. I think many have pointed to the fact that it's really when these securities are natively issued as tokens as opposed to wrapped, where a lot of the functionality really comes through. But at the same time, that's just one side of it. I think there's a lot of utility that comes through there, and even things we haven't talked about, like, say, posting those holdings with a third party to borrow against, or building software programmability around assets, things that are just not possible in traditional assets. But then on the other side of the business, you mentioned the digital transfer agent, which is something you guys have already built. How do you think about the sort of operational aspects of running an investments business? I think one of the probably realities of investment management over the past few decades is that there's been tremendous fee compression on the product side. I mean, Vanguard famously launched a suite of 5 basis point ETFs. Yet on the cost side, I don't get the sense that there's been the same level of efficiency enhancements and therefore cost savings, meaning the marginality of the business, I think, has been under pressure. How do you guys internally think about that as a firm? And in fact, I imagine that that's part of the reason you've built such a team to dedicate internally to building out this infrastructure.
Our original use case was all about the operational efficiencies that we were going to be able to gain. And it was only through doing that use case that we realized, wow, these rails are very impressive. We need to also invest in these new tokens. So it kind of started from an operational perspective for us. But yeah, I think that the most important enhancement we're going to see is that we can embed contracts inside of assets, and we can program clauses of the contract that governs that asset to be self-executing. And that is going to really allow us to keep up with these new blockchains where I can exchange assets and payments immediately, right? As you were saying earlier, it's not going to be T+1 or T+2. It's going to be 2 or 3 seconds, not 2 or 3 days until my transaction settles. And to keep up with that pace of activity, I'm going to need that level of automation that these smart contracts are going to be able to deliver. And I'm going to need the new capabilities of agentive AI to be overseeing the execution of all these contracts and ensuring that there isn't some mitigating circumstances that should cause me to put on a circuit breaker. So it's going to really bring a new level of automated oversight into the way that we run the financial system. It's going to become much more orchestrated and run automatically, much less human intervention, much less human functions, and much less need for reconciliation, right? Because if I don't have all these delays in the settlement of assets and payments, I don't need to put up as much capital to mitigate those operational risks. I don't need as many people doing reconciliation and trying to fix mismatched records. And so we're going to, I think, see a huge explosion in the volumes of transactions. I think we're going to see the speed, the velocity at which transactions occur increase significantly, right at a time where we're going to go away from being session-based to being 24/7. So it's going to be a whole new marketplace. It's really going to look and feel so much more efficient, and it's going to be less costly to run. But getting from where we are today to that, what sounds like almost nirvana, is going to take a lot of re-engineering, and it's going to take a lot of creativity. And I think that's why having started this journey early is giving us a real leg up, because we're having to grapple with the real life implications of, okay, well, how can I do that? And is there a new way to do that? And if I'm doing this in a new way, what is the implications for the other parts of my business? And how do I make sure that I am now not creating 2 separate processes, but I am creating a roadmap and a pathway to take me to a more efficient way of processing my funds? So I think it's an exciting journey, and it's going to have a great outcome, but it's going to be a lot of work for the next few years.
Yeah, totally. Sandy, listen, incredible conversation. I really appreciate your time and insights. It's just a pleasure to chat with you.
Oh, well, thank you. It's been really fun. And as always, I love chatting with you.
Sandy Kaul, thank you very much for joining us today.
Thank you.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.